Good morning, everybody. My name is Chaz Churchwell, founder, principal, Churchwell Insurance Agency. I'm here from my hometown of Dallas, Texas. Go Mavericks, and don't get me started on the Luka trade. I'm not happy about it. As some of you feel confused, that's probably the Canadians. So for you, I'll translate and say, go Stars. That might communicate a little better. You're going to find that, as he mentioned, our executive liability team exists to work hard protecting what our clients work hard to build. We do that really by utilizing a two-pronged approach. And you're going to find that with us, it's all about using peer-driven data and analytics to help our clients make informed decisions on what they're going to choose to assess their D&O coverage, et cetera, on what they want to pick. And so here's what I mean by that. If you are in a industry segment, you've got a specific market cap. So what we want to do is we want to look at that and help you understand what your peers are purchasing for your coverage and for D&O limits. And then also we're going to allow you to see what is what's being given out in judgments and settlements in securities litigation. Because once you understand your risk profile, your company can decide how much you want to absorb onto your balance sheet versus how much risk you want to transfer over, right? The other thing that we do that we feel is a big differentiator, many of you who are here that are directors, officers of companies, there is kind of a pride that some people take saying, oh, we're with Lockton, we're with Marsh, Aon, Gallagher. And what we believe and what we do is we lean into the fact that we're a boutique insurance agency. We're veteran owned, we're privately held. We have access to over 100 different markets though, ensuring that our clients are getting the right coverage at the right price. And here's what you will find. If you are with one of the big firms and you're a micro cap or small cap company, I'll let you know they're going to write your significant, but your insurance, but at risk of hurting some feelings, you're not significant to them. If you're sub 1 billion market cap and you are sub $1 million on your D&O premiums annually, they're going to throw something out to you, but they're not spending time on it. They're not properly taking time to make sure that you are serviced with excellence, that you're getting the best pricing they can give you. And most importantly, and what we're here to talk about today, is they're not taking time to negotiate policy wording for you. Because as I am confident everyone in this room agrees, policy wording matters. So here's the problem. D&O insurance has slid in the United States 54% over the past 9 quarters. And it's still just as profitable as it was 9 quarters ago. How are they doing that? It's by quietly shifting policy language to be less favorable, adding in additional exclusions, and setting it up to where they're withholding endorsements that are favorable to you unless your agent is specifically asking for them. So I know some of you are thinking to yourself, Chaz, that sucks for USA, kind of like the L Team Canada handed them in hockey the other day. But what does that have to do with Canadian insurance? Here's why. Because sadly, Canada, I want to let you know that even though the US and UK insurance policies are having somewhat of a clawback in coverages by default, unless your agent is asking for better stuff, what you will find is that it is still better than the sad, outdated 1980s policy wording that most D&O programs are written on right now. So my talk today is this. I want to talk to you about D&O dysfunction, how insurers are cheating you, and why it will cost you millions. So I want you to know that now we've talked about the fact that there is a wording problem, but why would insurers do that? So Mike Rossi is one of the top D&O coverage attorneys in the United States. He represents 30 of the Fortune 500 companies auditing their D&O program every year. And here's what you should know. Fortune 1000 companies, they audit their D&O programs every single year. But in the world of small cap and micro caps, this is something that's like a unicorn. I hardly ever run across anyone that ever audits their D&O program. But this guy, that's what he does. And he's sitting down conversing with one of the Chubb underwriting managers for public D&O just recently. And he's like, why are you guys clawing back so much of your coverage for Pubco D&O on the smaller caps? And his answer was this: because we can. Most insurance agents are clueless when it comes to policy wording. The ones that do know what's going on at the bigger shops are so busy that they're not going to take time, unless it's a huge client, to really focus on the wording. And as for the client, as long as we give them a high enough limit for a low enough price, and it's a name brand that gives them warm and fuzzies, they're going to buy it. So why would we give them more coverage than we have to? And this is Chubb, a well-known, established brand name. So here's what we're going to do. I want us to take a look real quick. I'm going to give you a few examples. I don't have time to fully unpack this wording issue in your D&O programs, but I want to give you a few samples. Hopefully I garner a little bit of trust, and I want you to know at the end of this, there's hope. I'm going to let you see the solution, all from a 30,000-foot view. So first one up, dual capacity or capacity exclusion. So this is going to be if you or someone is a director or officer at more than one company, and those, which I'm sure we all know people that are directors and officers at more than one company, right? If that is happening and any of those companies have interrelated dealings, there is the potential for litigation that names both of those companies and names that director or officer who's sitting in a position at both of those companies on the litigation twice. If that happens, what you'll find out is you could be excluded from coverage, and it could deny coverage to the entire thing. I'll give you an example for legal precedent. You've got Celestial Investments versus Kravolka and Mist Pharmaceutical versus Berkeley. Mist Pharma ends up getting sued in Delaware Chancery Court by Celestial, and Kravolka is this, Joseph Kravolka is this guy sitting on a board, and he gets accused of basically doing some bad dealings and of self-dealing, and there's allegations that he is not treating Celestial right as Mist chairman. And the reason for that is Celestial says that he is doing basically between Mist and Celestial, there is a series of other companies, and he says that he was manipulating them as somebody that sat on multiple boards to make it so that there was a really bad deal and defrauding them. So Mist Pharma, they go ahead and they seek coverage under their D&O because they settled for $12 million. Berkeley on the primary layer denies coverage. Why? Because Kravolka was sitting on the board of Mist, Aramax, and a couple of other companies along the way. And they end up appealing it, and they sue Berkeley. They appeal whenever it goes to the primary layer, and it ultimately ends up in a position to where New Jersey appellate court says, no, coverage denied, the exclusion's upheld. If you sit on multiple boards, if you're dealing with multiple companies and there's any interrelated actions, you need to make sure this exclusion's not in your policy. Let's talk about wrongful acts. Wrongful acts exclusion is baked into every D&O policy, and this is incredibly significant because it's not in and of itself a wrong thing. Fraud, stuff like that, that's what's going to be in your D&O policy under wrongful acts exclusion. And here's what you'll find. They have started putting in this nasty little A word, alleged. If there is an alleged wrongful act, coverage is being excluded. So you could be 100% innocent, done absolutely nothing wrong, and you will find yourself in a situation to where your D&O is going to leave you stranded out on an island because somebody simply accused you of doing something wrong. And none of us have ever had that happen, right? Nobody's ever been accused of something that they didn't do. So that is what we're seeing in wrongful acts, and carriers are increasingly baking that A word into there. Stepping into uncooperative insured or the duty to cooperate exclusion. Here's what you'll find. Very simple, very basic, but often getting baked in now into policy wording. So if there is an insured that's on your policy and they decide to become uncooperative, everybody, including the company, loses coverage. If the company itself decides that it is going to be uncooperative, everybody loses coverage. So this is something that you want to make sure that you're being cognizant of. SPACs, love them or hate them, SPACs are here and they are on a renaissance. There was an uptick last year. We've actually already had a couple go out this year that we've been a part of from a D&O perspective, and I've got like 3 more in my pipe. There's going to be an increase and uptick in SPACs again. So I want to hit you with one thing from the SPAC side and one thing from the target side that is a significant trend. So on the SPAC side, sponsors. Sponsors, you may or may not know, are never included on a D&O policy by default. They're not a director. They're not an officer. Ross, I know you've been actually doing some SPAC work lately. Let me ask you a question. What have you been seeing with sponsors getting listed in litigation? Yeah, so he might be dressed casual, but up here, he's all tuxedo. The guy is smart. It's Ross Carmel over at Sequenzia. But so here's what you'll know. We are seeing, over the past 6 years specifically, a massive uptick in sponsors being named in securities litigation. You'll find that I've got 3 different companies to where the SPAC and the target are listed. You don't have to take my word for it. That's case law right there. And then we'll slide over and let's talk about the target side, wrongful transaction language. As many of you probably know, if you are the go-forward company in a de-SPAC, you never had an IPO. Think about it. You did a reverse merger. There's no IPO. But default policy language on a D&O is going to give reference to an IPO event, uplist, and crosslist, but you're never going to see default language giving reference to a reverse merger. And so we are seeing a trend to where target companies are having coverage denied in association with the de-SPAC event because of the fact that their agent did not work with the carrier to get proper language wording in there to address the reverse merger. So now I want to get into allocation. And hear me on this. If you've tuned me out, this is where you chime in. Allocation is the most litigated and negotiated part of any D&O claim. And here's why it's incredibly significant. So let's talk about defining it. So allocation is who pays what whenever you have things that are covered and things that are excluded in coverage, when you have people that are covered and people that are non-insured that are listed in the litigation, okay? So you'll see 2 examples on there. You'll see that we've got like 7 people covered, 2 not, for 9 allegations. You've got a lawsuit naming 7 defendants, 2 not. And here's what 5 covered, 2 not on the companies. So here's why you want to really pay attention to this. Because you might think, oh, okay, so 7/9 of this is going to be covered. That's assuming that everything has an equitable distribution. And in a minute, we're going to talk about allocation language where you're going to see that it is not an equitable distribution. And so what you will find is that when you have this, the insurer will basically get to make a subjective statement as to what they feel. They may say that those 2 items carry 50% of the weight of everything in the allegations. And that right there, if you've got a $20 million settlement, they may say, we really only feel that we should be responsible for 10 of that. And so now it gets even more significant because if you have a self-insured retention, some of you may think of it as a deductible, that $1 million, $2 million that you have on the front end before your insurer kicks in, you're going to find that we've got a thing to where, oh, I'm getting the wrap it up thing. Sorry, guys. We're going to find that you will be in a position to where you could functionally double or triple your self-insured retention, leaving you on the hook for millions and millions of dollars. So that allocation wording, this is the key that you want to look for. Relative. If you look in your allocation wording, do a keyword search, look for relative in there. You see relative legal, relative benefits, relative financial exposure, then you have poor allocation wording, and that is the common language being used in most D&O forms by default today. So there is an example of good allocation wording. You want to see best efforts, but no relative language. And then here's my deal. Here's a QR code. Scan this QR code real fast. I'm willing to take a $7,500 or $7,500 gamble. I want to spend $40K here today. I want to spend $40,000. And I want to pay that guy, Mike Rossi, that I said is legendary in North America for D&O insurance. I want to pay for him to audit your company. If you're a qualified company, for Mike will do it. I want to pay for him to audit your D&O program. So scan that, takes you 60 seconds of effort, and then let us have an opportunity to pop the hood and see if your D&O coverage is busted or if it's brilliant. There's nothing to lose on that. And again, my name is Chaz with Churchwell Insurance Agency. I'm out of time, but I'll be right out in the lobby if anybody has any questions. I'd be honored for the opportunity to talk.